Okay. Okay. Hello, everybody. This is the Option Professor, and we are going to be going over um, things in the marketplace like psychology and discipline and time management when you're doing your trading. And I'm going to be giving my opinion and my views on that. Just a quick background on myself. I'm a graduate of Don Bosco Prep up in Ramsey, New Jersey, and Boston College up in Chestnut Hill, Massachusetts. And I've been in the investment arena here for over 3 decades. And I have traded thousands and thousands of contracts on the options and shares and bonds and currencies and the whole 9 yards. So I am very knowledgeable and I'm very experienced in this area. And I'm going to share you my opinions and my views on these things. And I am going to reiterate, though, that I'm not giving advice out to anybody because obviously I have no personal knowledge of everyone who's listening. So obviously you can't give advice out to people you don't know. So at any rate, I will be giving you my opinions and my views on this stuff. Now, let's get into, I'm going to show you a bunch of different markets and give you some idea of what's going on. As far as the psychology, I think the psychology in the market and the psychology you want to have is that you're in control in a situation of which you have no control, right? I mean, we have no idea exactly what's going to happen every day to these markets, and we have no idea what's up, down, or sideways. We have no idea of geopolitical events that can occur. We don't have any exact idea of what the monetary and fiscal policies are going to be. So when you think about it, there's a ton of unknowns out there. And so your psychology, in my view, has got to be trying to get some method, some idea on how to put some, shall we say, concrete situations that you rely on to kind of take all the information that's out there, and you got to figure that at least what is known is in the price already, and it is also in the direction of the price. So basically, if news changes, and if events change, then the price will change. And so what we like to have in psychology of the market is we try to have some methodologies that gives us some numerical analysis on what the heck the prices are doing and try to give us a probability feeling of what the prices may continue to be doing afterwards. And so again, when you are talking about the psychology of a trader, I think it comes down to consistency. I mean, I think it's probably better to have a consistent amount of contracts or shares that you're doing rather than willy-nilly just changing your quantities all over the place. Because I think psychologically, that would be a very rough racket because you make big bets, small bets, and they're all over the place. And then, of course, I think psychologically, if you have anxiety all the time when you're trading, that's probably your first inclination that you're in over your head or that your methodology is flawed. So you should not be anxious constantly, and you should not be going through psychological ups and downs dramatically when you're trading. If you can keep your steady head and you can keep a clear head, you're probably going to have a lot better chance of seeing some success than if you're all over the place with no discipline and you're just all over the place. So psychologically, I think what you should be trying to do is basically get a methodology that gives you peace of mind, whatever that is. And I'll share with you some of the things that I do to give a little bit more of a balanced mental state and a little bit more of a calmness where you're doing a transaction, it's going to work or it's not going to work. And it's not going to be the end of the world one way or the other. And you certainly want them to work, but if they don't work, they're not going to damage you that much. And if they start working, they could obviously enhance you. So psychologically, again, my suggestion would be come up with some methodology where you're not anxious. If you're anxious, that's the red flag that you're doing something wrong somewhere along the line. And the other thing is in our view, is to try to rely on numerical, shall we say, quantitative and numerical price-oriented factors, as opposed to news reports and just chasing the market around on every news report that comes out. As far as a discipline is concerned, when you use numerical indicators, They're going to be telling you to do something or telling you to do something else. They're based on the price. Now, granted, they are based on prices that have already occurred, because nobody has charts on what's going to happen. So what you can only work on, and that's why they can have that disclosure. Past performance is not indicative of future results, because again, everything we look at is going to be on a historical price basis, and they may or may not be worthwhile looking forward, because if some event occurs that changes everything, obviously the prices are not going to be factoring that in advance. So anyway, the discipline that we get is from the numerical analytical stuff that we do. And then, of course, the other discipline is money management. And then the third discipline is risk management, which I can get into as well. Now, we're going to be having a seminar on the 31st of May, where I'm going to be able to get into much greater detail than I will today on some of these risk management things I'm going to talk about. So if you are interested in trying to learn about hedging or protecting yourself against market declines, or if you'd like to reduce your cash risk and protect yourself against a big upside surprise, like in the last couple of days, this is a little bit of a surprise. We're at 3,800 on the S&P. As I do this broadcast, we're at 3,968. That's 168 point move in a couple of days. That's a pretty big upside surprise. There is a strategy that we'll talk about on May 31st that can hedge you against that type of thing, because a lot of people who sold out at 3,800 are not very happy today, because the market's at 3,968 as of this broadcast. So that's an upside surprise. And we have an ability to hedge on that. So again, discipline comes from using the numbers and just following the numbers. And then the second one would be to use some type of risk management. And the other would be to have position management. So those are three disciplines. And again, on the risk management, stop losses would be one, but also using the options as a hedge against up or down moves is another. And then, of course, the other situation is discipline on how many positions you have. Don't let one transaction make or break your account. Okay, so let's take a look at also time management. I don't want to be doing this thing 24 hours a day. I don't want to be doing it at 2 in the morning and still trying to figure out where things are. So, there's some indicators that I'm looking at. Now, today, I'm only going to be sharing with you some shorter term ones. We have another group of indicators we're going to go over on May 31st at that meeting. So don't forget to get to that meeting, or I think it'll be on YouTube. You could check it out afterwards. But again, in this broadcast here, I'm not going to be able to go over all the different strategies that I'm going to be going over on the 31st. But anyway, let's start out and start discussing some of the disciplines that we use. And again, this is just one group of indicators. Again, there's a whole separate group I'm going to be going over that are different than these. So I use these plus the other indicators, but I don't have time to go over both. So that's why the May 31st meeting is important. Okay, let's get started. With regards to the moving averages here, I use here on a shorter term trading kind of stuff, a crossover. Okay, a crossover moving average situation. And I use a relative strength index. Okay, now, again, why do I use the moving averages? They're based on price and time, and they smooth out the edges. Okay, and they give me an idea of the overall direction of where the market's going, and that is helpful. It also gives me where I might use a get out point if the averages cross, or at least use the averages as some type of mechanism to follow the risk. Again, on the relative strength index, why I like to do that? Because it tells me the heartbeat of the market. Again, if the heartbeat is 50 or above, you've got a very strong heartbeat. If it's 60 or above, you've got an accelerating heartbeat, which means the market is strong above 50, and above 60, you have a good shot of accelerating to the upside. On the downside of the RSI, the heartbeat is weakening under 50, and that's not good if you're long. So you got to be concerned. If the stuff you own has RSI under 50, you're not holding something good. You could be holding on a very big time bomb. So we don't want that, do we? Okay, now, with regards to if that RSI breaks under 40, now you could start accelerating to the downside. So those are some of your parameters, basic parameters on the RSI and also on the moving averages. So the other thing that we like to do with regards to a discipline is we like to look at things on different time periods. Okay. Now we'll take a look here. First, we look at a 20-year basis. Now this is on the S&P 500. Okay, so what is this chart telling me? I'll tell you what it's telling me. On the 10 SMA, it peaked out at 3509 on the 20-year graph. Okay, and it is pointing down. You see the high on the relative strength. I mean, on the MA was 4482, and now it's at 4424. So that the 10 moving average on the close is moving down. That's not good. Now you've got a 20 moving average on the closing, and that comes in at 4170. And so basically that is still rising, I believe. Let's see, 4108. Yeah, that's still rising. So that's a good thing. So you got one showing a little bit of weakness and the other one showing a little bit of strength. Okay, your RSI, again, pointing down and coming in at 54. So it's still positive. You see, this thing's been in a bull market, as you can see from the indicators I'm talking about, since 2010. So this thing's, you know, you would have bought and hold if you're using RSI. Never got under 50. Even during the crash, it only went to 50, 49.96. So can you see staying above 50 is an important thing? Yeah. So again, now it's still above 50. So again, it could be a good situation still, although it has broken down underneath all the averages, which is obviously not good. So the price is worse than the RSI. The relative strength market is still relatively positive because it's still above 50, but the prices stink. And one of the reasons is there's a fundamental reason is that the market has changed its valuation. You know, we've been telling people that this thing was done for a while. You see at 4,800 up here, 4,850. Look how far it is from the moving average. You know, if you get 800 points away from the lower average, you're very, very far away. Even during the crash here at 2,200, the average was only 2,800. That's 600 points under. Here you were about 800 points above. So that's off the chart. The likelihood of it reverting back to the mean, you've heard of reverting back to the mean. This is called reverting back to the mean. So the discipline that we're getting from this average is it's telling us that the market is extremely overbought in January, and it has a likelihood of coming down. Now, if you add to that the Fed decided in November of 2021 that they were pivoting to fighting inflation, then if you've been around the block, and I've been around the block, you have valuations of 22 to 1 on the PE ratio on the S&P because interest rates were at zero almost, right? And you had inflation, which was not very high for a lot of those years. It's only in the last year that the inflation picked up. So if you have no inflation and no interest rates, don't you think your valuation is going to be 22? Well, what do you think is going to happen to valuations if interest rates on the 10-year goes to 3%? And inflation goes to 9. They're going to tighten. So here's how the math works. And this is a discipline as well. The S&P is going to earn, they say, $2.30 this year. If I do 22 to 1 PE ratio, I'm at 5,060 on the S&P. But if I go down to 17 PE ratio, I'm at 3910, which is more like where we are now. And if it overshoots to the downside and goes down to 14 PE ratio times $2.30, you could go down to 32.20. Now you see that's 32.20 right there. That's not off the chart if things get hairy. And if you go to 14 PE ratio times $2.30, you get, if you go to 15, I'll give you some different numbers to look at. If you went down to 15 PE ratio, you go to 34.50. Where's 34.50? Right around that high, right around the high point where we started this thing from. There's 34.50. Is that off the chart? No. So if we're going to be going down towards the 15 or 14 PE ratio, you're going to be looking at 32, 3,400. And if we're going to go to 16, because we already hit 17, right? So say we're going to go to 16 on the PE ratio, then you're looking at 3,680. And that comes in right around here, right around those highs. So those are your three lines in the sand as far as catching the falling knife, okay? 3,680, if you're going to go to a PE ratio of 16, 15 brings you to 3,450. And the 14 PE would take you to about 3,220, okay? Now that's all based on a $2.30 of earnings on the S&P 500. If that were to be higher, then that would change the number, right? Say you came in at 240 and now you're at a 15 PE ratio. Now you're at 3,600. So again, if it's a little bit better earnings, that will buffer the decline, okay? But if we go into recession and they start cutting earnings forecasts, it's going to be bar the door, Katie, because then you don't know where this thing's going as far as, you know, you're going to take a multiple. And then if you, I mean, let's just say they cut earnings by 15%. So you go from $2.30 and you went down to $1.95. 195 times 15. And now you're talking 29.25. So do you see how we analyze things? We analyze things on basic numbers, PE ratio times the earnings, moving averages, relative strength. That gives us what? It gives us discipline. It helps with time management, because how long does it take to look at the graph? The computer does all the work figuring out the price. Doesn't take that much time. And as far as psychologically, I got a plan. I've got numbers that I know I'm looking for that are lines in the sand. That psychologically keeps me balanced, and it psychologically, you know, makes me feel better. Also, as far as the amount of positions I have on anything, of course, you know, if you have a discipline to that and you are moderate in your position planning, then no one position should be causing you that much angst. Okay, so that's where the psychology comes in. That's where the discipline comes in, and the time management. They all converge into one. 3 different roads, and they all lead in the same direction. Okay, so there you go. That's what it looks like on a 20-year basis. Getting back above 41.35. What's the number down here? Call it 41. Getting back above 41.70 would be very constructive for the stock market. Getting back above 44.24 would be outstanding, particularly if it could hold it, because we did see a move to 46.31, and then the market went way down again because it couldn't hold the gain up there. All right, let's look at a different time zone. Let's go to the 5-year. And you can see that's pretty sad looking. Both averages are pointing straight down. There you got that move to 4,600. When it breaks the number but can't last, that's not good. And you can see that you're under 50 on the RSI, which is also not good. So could we have bear market rallies? You bet you could. But the momentum on the averages are still pointing to the downside. Turning to the 1-year. Both still pointing to the downside. RSI still well under 50. So yes, did we have a little bounce because we're oversold? Yeah, but you got to be careful how far it's going to go. Last time it failed at 4,100. So we'll see if it can take out that. You have a bit of a divergence. Now I'm giving you a tip here. Okay. That low here is at 38.59. The RSI low down here was 37. This low was 3,800. So that's quite a bit lower than that, 50 points lower. But the RSI only went down to 38, not the 37. So that's a bit of a divergence, which means what? You made a lower low, but the RSI did not make a lower low. That means it could be exhaustion. And obviously that gives you a nice bounce back. So if you're looking at it, that's called a divergence. And that's pretty good. That's pretty good. I'll give you another one here. If you go over to November 2021, which is when the Fed decided to pivot, you had a high point here of 46.90. And then you had a high point here of 47.25. But look, the RSI was 67 and then it was only 64. That's a divergence. And what happened after that? You went from 4,700 down to 4,500. That's 250 point drop. And did you notice all the next highs were also lower? This is telling you that you got a tired market. So right now we got a little bit of a sign that the market is tired of going down. Again, we also know that interest rates are a big part to watch. So we'll give you another little tip here. You put TNX up in the box and you go to the 10-year note. Now, we told people that March of 2020 was the low on the price of yields on the 10-year, and that yields were going to be going up substantially. So let's look at the 20-year and let me show you where I got that from. Okay, there's the 20-year graph right here. Boom. And you'll see, look at that. I mean, talk about that's a 0.42% interest rate. 0.42, that's almost negative interest rate. And you know where this cycle started? It started at 16% interest in 1982 or 1981. So you had a 20-year cycle that ended right there. And can you see it's been up and away on interest rates? Now it's stalled out here at 325. Can you see why? Because that's the former high of 2018. So what is the Fed thinking? Let's bring it up to 2018 and see if that's enough to slow inflation and slow the economy. If it is, then maybe rates may not go much higher because now they're at 286. And that's why the stock market has turned around, because yields are going down and maybe could be have peaked. If we get above 325, well, that opens the window to all this stuff, and that's when it gets a little more scary. So if you're out there right now, keep an eye on the 10-year note. You start breaking above 325, you might want to take defensive tactics, okay? Because these rates going higher and higher and higher are not going to help valuations. It's going to make valuations even drop further, in our view. Again, this is all our opinion. Okay, so keep an eye on the 10-year at 325. If we can stay under here, and look how overbought it is, maybe it's going to come and go into a trading range. That would be helpful for stocks. That would be helpful for stocks. Okay, particularly tech, because tech is obviously very affected by the interest rates. And that's why some of the higher flyers are getting a bounce as well. Okay, going back to where we were. Some of you people like to do short-term trading. Well, if I'm doing short-term trading, let me show you what I use for that. Okay, so on a 1-month basis here, when they cross over, you get a buy signal, you ride it up, got sloppy here, got a buy signal, got a sell signal up here, got all the way down to here, got a buy signal, a little bit of a pop, got a sell signal, and right now you're on a buy signal at 3,900, and it's telling you to get in there and look at the RSIs above 50. So if you're a short-term trader, obviously you got the buy signal, you should be long. Okay, that's on a short-term basis. Again, on a 1-year basis, you know, you haven't gotten any signal that is turned. This is a turn. You see, this is a turn, right? And then you can get in there. Now, you're not get to the bottom. You don't get the bottom, but you're getting it when momentum is turned up and when the RSI is above 50. And then you got a decent shot at making a little bit of money, maybe. Okay. Now, it doesn't last very long here. But again, for us to really think that there's something of any significance here, we certainly would want these two lines to cross to the upside, because again, that's when you get a reasonable movement. So lines cross and you get above 50, then you might be onto something. Okay. So there you go. You get a little bit of an idea on how to create some discipline. You get a little bit of an idea on how to do time management, because how much time does it take? You know, when you get, like, say you got a buy signal here, it is what? It is on October 13th, right? Okay, you got it, and you leave it alone. You leave it alone. Now, if you want to keep things on a very tight leash, the first line is the 10 moving average. Okay, you could, as soon as that penetrates, you know, use that as a get in, get out, because that's going to be the first one that gets penetrated. So right now, if we can close above 39.70, that's your first signal that it could be turning. Okay, but the direction of it is still pretty lousy. Here you got above it, right? But you couldn't get above the second line. And that's why when they cross is a much safer time to start thinking that what? You might be onto something. Here it crossed, but the RSI wasn't above 50, so you shouldn't have bid. You shouldn't have bid, right? So, the two things, and this is a discipline, okay? Because again, if you don't have discipline, what happens? Oh, you see the lines crossing, but the RSI is not above 50, but you still think it's going to go, so you get in there. Well, you lost your discipline because you didn't wait for RSI to get above 50, and it cost you money because it got right back underneath the numbers, okay? That's where the discipline comes in. You have to have parameters. You have to stick with them. And yeah, you don't have to want to trade all the time. You have to be convinced to trade, right? So that's a big difference as well, psychologically. I don't wake up in the morning going, I'd love to risk all this money today. I want proof and evidence that compels me to act, okay? Proof and evidence in this case would be what? The average is crossing, the RSI above 50. That's evidence, that's some proof. I'll take a shot, right? Okay, so that gives you a little bit of an idea. Let's go around the horn here and we'll talk about some of the different markets. QQQ is obviously your tech stocks. I'm going to go over some of the major indexes and then you could extrapolate from there. Okay, you go to the 20-year graph on the NASDAQ. What's it look like? Looks pretty lousy. It's still above 50 though. So again, it could be something that could get better or could stabilize down here. You're very far from the averages, so a rally's not off the table. Okay. Turning towards the 5-year graph. Very oversold. You got a low there surrounded by higher lows. That's another discipline. Okay. You've got a line in the sand, 280. So if you want to buy it down here, again, it's very risky because obviously what? RSI is very weak, but if you are very aggressive, that would be a line in the sand of which to defend. But again, you don't have everything, going for you. Turning to the 1 year. Again, RSI stinks. You do have a tradable low there at 280. It's coming into some resistance right here and some resistance right there. Real short-term gambling, trading, speculating, whatever you want to call it. You are above both averages, which is good. And they both come in around 288, 289, but they haven't crossed yet. RSI hasn't crossed. But if we do get these things to cross and RSI gets above 50, you might have a short-term trade on the upside developing. But right now you don't. You jump in the gun. It might work out. If it goes to 300 and these things now cross over, yeah, you were smart to get in here. But again, if you are getting in here aggressively, you'd keep it on a short leash more than likely. Okay, so that's your story on the Qs. Why don't we look at the small caps? Okay, this is the Russell 2000. And on the Russell 2000, let's take a look. All right, so there you go. Russell 2000 came down to some support. See those former highs? That's support. So it made a line in the sand here at about 169. What is it? The low was 169, so 168.90. That's your line in the sand if you want to trade against it, okay? And it is still above 50, so right there, this is a place where it would stop. So if you want to trade against 169 and you're aggressive, that would be something you could do. Now let's turn to the shorter term stuff. We'll go to the 5-year. Still looks pretty lousy, plenty of resistance above, and RSI is still under 50. But again, it is set up to have a bear market rally, possibly. Now let's take a 1 year. It's above the 1 year there. So right now you can use that as a parameter, which is 176 area. RSI is still under 50, so that looks lousy. Here's a formation that we would recognize, though. You see a low there. That's a move up here to 182. That's called a 1 move. Pullback here is 172. That's a 2 move. You notice the 2 move didn't take out the bottom. That's very constructive. And now if you take out 182, you could get a very nice rally. So that's called a 1, 2, 3 formation, and that can be very powerful. So keep an eye on this thing. Again, it being above 176 is a positive, and it getting above 182 would be an add. And then you might get onto something, because maybe this RSI can go from 40 up to 50, maybe even get above 50 if it's going to be good. If interest rates are not going much higher than 325, which they've already hit, and if we actually see them decline, stuff like the small caps, stuff like the tech would benefit from that. Okay, let's look at the short term for the people that are speculating. See, this is just about ready to cross. Okay, so this one looks better. Your RSI is above 50. That's a good thing. Your things are just about ready to cross. 176.29, 176.43. So if I was a short-term trader here, I'd be probably taking a shot here, especially if you can get above 180. And then basically your line in the sand would be about 176. And since the RSI is above 50, you might be set up to make a little money on this thing on a short-term basis. It almost looks like it's trying to set up a little head and shoulders low here too, with your line in the sand on the shoulder here at around 175. Your neckline coming in at around 179. So breaking above 180 would probably be, I'd want to see something like that, because again, since it is so overall weak, I wouldn't mind seeing just a little bit more positive momentum, which would make these lines cross, which would get me a little bit of a higher RSI and give me a little more confidence that maybe it's going someplace. Okay, so that's your Russell index that we give you. And again, on a long-term basis, again, the Russell did hit some support using these as these former highs as a support zone. So keep an eye on the Russell. Does look like it is trying to make a turn. What else is out there? The banks started to go pretty big. Let's start looking at the banks. Now, again, the banks have very good situations going as far as what? As far as, people out there are working, people out there are now gone through their savings and now they're hitting those credit cards. Those credit cards are very good for the bank. Defaults are very low because people are paying on their houses. And so unless we have a real estate crisis, which could happen, how could that happen? Well, if interest rates on the mortgages, which are in the mid 5s, go up to the mid 6s, all of a sudden you can't refi things, and all of a sudden the economy slows, and say the price of real estate drops to 20% and you only put 5% down, now you're underwater, 15% negative equity. And we remember negative equity sometimes leads to abandoning of the property. That would cause the banks some problems because they're holding paper maybe. Okay. The Fed is not buying mortgages anymore, and that's a big problem. That's why yields on the mortgages have gone from 3.5 to 5.5. Okay. So let's talk about the banks now, though. Again, they came down here almost to some support at 31. And now they're trying to get back above the bicycle here, which would take us above 35. So if you can get above 35, that would be very positive for XLF. This is a basket of the banks, mostly large banks like JP Morgan, Bank of America, Citigroup, you know the names. Okay, so let's take a look there. And again, it's above 50. So it's still in a constructive long-term position. 5-year graph is telling me what? Telling me it still looks lousy and it's still underwater, but it could have a bear market rally, right? There you go. And 35 is a big number here because look, it's going to have resistance there at around 35, 36. And then basically we saw the other number was 35. So that neighborhood could be some problems. Then you took at the 1-year graph. It did see it's trying to make it's in the zone here between the two, right? So again, staying above 33.40 and getting above 34.25. Those are your two key numbers. That gives you the discipline. That gives you the what? The psychological comfort that you have physical numbers you're looking at. Okay, but again, they haven't crossed. That's not good. And the RSI is under 50. That's not good. And you have to look at it that way. You can't look at the numbers and hope they fill in your opinion. They are the numbers. They're working off price and time. They're not guessing. Okay, now if you're a short-term trader, what it looks like now. Got your buy signal when they crossed right here. So right here, a pop above 33 was your get in point. They have crossed to the upside here. That's good. They're at 33. So you don't want the thing really getting under 33. And basically the RSI is above 50. So once the RSI, which was really under 33, more like 32, that's really where you got your signal. Now, again, there seems to be some resistance right here. That's why it stopped. 3450 area. There's some resistance on a short-term basis. And there's a gap. So I don't know if that's going to come down and fill it or not. But it, if it did fill it, and if it holds 33 and this RSI holds 50 and it gets going back up again, that would be constructive, but it has not been constructive in a while. As you can see, it's been deteriorating. Okay, so that gives you a little bit on the financials. And, another thing out there that's is the energy. So let's take a look at that, because our premise is that we may see a high point in commodities this year. Now let's go again, because I say this all the time in our updates. Again, I'm going to show you why we thought the interest rates had hit their high point in price and low point in 2020. And we're going to go out here so you can again look at this. This is TLT, which is a 20-year bond. You see, when it gets to 180, which was March of that year, and the moving averages are way the heck down here, that is called a blow off, and it has a high probability of coming back down. Couple that with that, the inflation is going nuts in the years that followed, right? And why would have inflation gone crazy? Because they printed a ridiculous amount of money during the COVID crisis, like $9 trillion on their balance sheet. And they put interest rates at 0. And they plugged in all that money in consumers' pockets. So they got money coming in from the government, spending it. They got interest rates at 0, so they can buy all this stuff with no money down, with no interest. So they obviously could get all the durable goods they wanted. And the inflation obviously is going to come back up with that kind of scenario. And when inflation goes to where they do, interest rates are not going to stay low. They're going to flip around. So this is a wipeout. People in fixed income, if you're in there, you know what I'm talking about. This is like 10, 15, 20% losses or more. Now, that's fixed income. You normally don't lose that kind of money. It basically generally is steady. So this is a very big move and a very big change in the Fed's policy right there. And we told people right there, get out of the bonds, go to ladders, short-term ladders. And if you don't know what that means, go to the meeting on the 31st. We'll explain it. But that was what we said. Now, let's talk about on the S&P. Why did we think the stock market was going to be hitting a peak? Well, let's take a look at it. Okay, even just going back 10 years on this. Let's go back 20. There you go. Again, we showed you this before. You're way up at 4,800. The average is way down here. And the Fed's hiking? Come on, how's it going to keep going? Valuations have to come down because rates are higher, inflation's higher. End of story. Everything else is conversation. To keep you on the TV, watching the TV all the time with, fast this and slow that, right? Or the newsletters for $5,000 a year, $10,000 a year, telling you that they bought Amazon back in 2000, like you're going to really get Amazon at 2000 price again. What does that matter? Okay. So the bottom line is that, that's why you have to get independent sources that have no axe to grind. So again, now we've come way down. So now it's a different bit of a ball game. But again, if the interest rates get above 325 on the 10-year, the valuations could obviously contract further. All right, now, so let's show you why we were thinking that the crude oil might be hitting a high point this year. Because nobody's talking like that, are they? Now, oil is about half of this index I'm going to show you in a minute. Now, there's your 20-year graph on oil. Does that look like a blow off top at 131, 132? Look what a moving average was, 86. Have we seen any 132s lately? No. And where's the former high? 147. So our premise this year is 147 is the high. It's possible it goes up and tries to test that area if something weird happens in energy. But more than likely, again, the other side of the coin is we have hyperinflation. Oil goes to $200 a barrel, and obviously everything's a mess. We're not betting that way. We're not thinking that. We're thinking that 147 is going to hold. It's a 50-50 chance right now. 131 was the high. And, it's possible that we are going to see this thing reverse itself after this year. Let's look at the price of soybeans, which is another big factor. And let's see what that looks like. And this would obviously affect the fertilizer companies and things like that. Again, up near its all-time high, very far away from its averages. And look, another divergence. You see the high here on the RSI was 69, and now it's 63. And look at that high. That could be exhaustion. Okay. And then let's look at the metals, which is the other big factor in the commodity index. And this is the price of gold. Okay, so here you got a double top up there. And the gold is trying to hang in there. I have to give it credit. Okay, I don't know if there's going to be another little pop here or if gold's going to go in a different direction. But I will tell you, if you're talking about a divergence, you don't get much of a bigger one than this. This is what? RSI of like over 70. Then you made a high up here and the RSI was down at 57. That's a huge differential. So my feeling here on gold is something could be happening with the economic system, that if it got hairy for whatever reason, because we've got Xi looking at Taiwan, we've got Putin doing whatever the heck he's doing over there with nuclear weapons, and supposedly he's sick. Who knows what goes on? So if something occurs, these two averages have crossed, and they are at 1835 and 1822. If we break under there, and this RSI for whatever reason breaks under 50, then I would get very negative on the gold. Very negative. But right now, the way it's set up and the way the pullback has occurred, it has been holding these levels, 1800. And so we're keeping an eye on gold. We'll show you on a short term basis what it looks like there. Don't forget, the central banks have a lot of gold. They don't have crypto. Okay, so there you go on gold. You see it's right there on the ledge. You'd need closes above 1900 and then 1950, and then we would be all in. Okay. If you don't get 1950, now this is something that's just being very tricky right now. A little too tricky for me, to be honest. And on the 1 year, it's trying to go back up. It has popped back above it. So that's good. It's above 1856, 1831, but they haven't crossed, have they? And we're still under 50, aren't we? So you see, I want them to cross and get the RSI above 50, and that's my discipline. So that's why I'm not doing anything, right? But believe me, if it starts crossing like that, you'll get a knock on the door, because I think that'll be the time to open it up. And then short-term trader started getting some buy signals down here. Sloppy though, right? Up, down, up, broke it, sloppy. But it is above 50. Can't deny that. And right now it is right at the ledge here. Both averages are at 1855 ballpark figure. So if it gets above 1860, I'm sure it'd probably be going higher. And if it starts breaking under 1850, 1840, it might start rolling over. So you got some parameters there of which to work with. But as far as the bigger picture is concerned, so anyway, the soybeans, look like they may have peaked. The oil looks like it may have peaked. That's why we're not coming out and saying the commodities have peaked this year yet, because the jury is still out. But we suspect they will, And if we get more conclusive evidence, obviously that's when we'd pound the table. We don't really have that yet, but it's starting to develop possibly. The alternative to theory of what we're talking about is that hyperinflation is going to be coming and things are going to go through the roof. Okay. Let's look at one last thing, which is China. Okay. Two main things here, because, you know, China's all locked up, right? So if China is going to let their people out of their apartments, I guess they tape them closed. Can you believe it? If they're going to let them out of their apartments, is there an opportunity? And I would think the pent-up demand would be tremendous. Do you remember how when we were locked down, what the pent-up demand was when people got out of the, you know, the COVID and the masks are off? So keep an eye on this one. This is large cap China. The low has been 26. It's trading 30. RSI is still weak. So you don't really have any great buy signal here, but just let's keep an eye on it. You've got, again, nothing to report here yet. Okay. But that's a pretty discounted price, right? Half price. And then you've got a buy signal on the 1 year right now, but not a buy signal. Why? It's above the averages. Have they crossed? No. Is the RSI above 50? No. So you don't have a buy signal, but is one developing? Yes, one is developing. That's why I'm bringing it to your attention. The other part of that is K-Web. And this is their internet. Now, this thing got whacked. Wait till you see the wait till you see the prices here. Okay, talk about a drop, huh? Let's look at the 20 years so you get in perspective. That's called a blow off top. You understand why we stay away from that stuff? Because look where the averages are and look where the price is. And if you buy in up there, I don't know if you bought the top of the stock market at 4,800 or you bought bonds when they were at 1% interest, but if you did, you bought the top of a very big blow off. And obviously your statements are obviously very red. So we want to avoid very red statements. So we want no part of blow off tops. Now, is this a blow off bottom? It possibly could be. Look, the low is 20. We're trading 26. It's way away from the averages. The RSI is right down here at 39. Remember I told you about RSI? If it goes under 40, you could accelerate to the downside. If it doesn't get under 40, it could start matriculating back up. Do we have anything happening on the 1 year? The 1 year is trying to cross, but the RSI can't get above 50. So that's why you have to be patient. But is it developing? It's trying to develop. And staying above 26 would be nice. So we're keeping an eye on that. And if China was also going to be any good, you would think Las Vegas Sands, because after these people get unlocked from their apartments, they probably want to go have some fun. Some people find going to the Las Vegas Sands over in Macau fun. And so we are keeping an eye on this too. Because if you notice this stock as well, this thing used to be as high as 148, and then he was at 80, and now you're picking it up in the $30 area. So obviously we're looking to see if there's a turn down here, turn up from here as well. So if there is a turn in China and they don't attack Taiwan, there could be situations here as well. Also, we are watching very closely the airlines, the rent-a-cars, and the hotels here in the US, because obviously it's possible they could be making a whole bunch of money this summer with people going nuts and trying to go someplace. So again, that's some of the things that we talk about. One other thing I did want to say is on the May 31st meeting, we're going to be able to go over options and have more time to do it. And again, we share our views. And we're doing this over 30 years. And again, we've traded thousands of these contracts. We're going to go over how we look at the strike prices. How do we select them? How do we select expiration dates? How we would do spreads, how you can leg into a spread and hedge your risk. How can you use these options to protect against market declines? I mean, if you would have done hedging, you'd have none of these kind of losses that you're looking at. Using puts and calls as a hedge. Also replacement trades. You know, people who run away from the market at 3,800 may not be so happy, especially if we're in a situation where in a year from now, all of this stuff is behind us. So we go over replacement trades as well. And then, of course, we go over rolling up and rolling down your position. And then when you hear about unusual option activity, How do we select the strike price on that activity? And then how do we get our money out of our original position by spreading it after the fact? There is a lot to learn. And obviously in this short broadcast, I couldn't give you everything, but I can tell you that the discipline we talk about comes from working the numbers. The psychology, peace of mind, getting anxiety out of our system comes from relying on what the numbers tell us. And time management, after the numbers tell you what's going on, there's no more discussion. They are what they are. So again, I'm inviting you to go to our website, optionprofessor.com, put in your email and your information, a valid phone, and we'll invite you to we'll get you the link to the May 31st meeting. We'll also explain how you can get the PDF report, how to hedge against market declines and market advances, and we'll discuss how you could take advantage of a 30 to 45 minute one-on-one session where your questions could be answered. We can go over things that have caused you losses and how you could have behaved differently. And then we'll also offer our opinions on how to operate as well. So again, optionprofessor.com, and we'll see you at the meeting on the 31st. And again, we'll give you the details and get that PDF report out to you on hedging downside risk and upside surprises. Thanks for being here, guys. I hope all your trades are good ones, and I'll be talking to you soon. We'll see you on the 31st. optionprofessor.com.